Hello and welcome to this week's stock analysis. This is a video I try to do every 1 or 2 weeks. I'll analyze one single stock which is given to me by one of my listeners. And this time one of my listeners, Einar Repse, gave me a whole list of tickers he wanted me to analyze, but I chose to go for ORCL today. So we're here at Google Finance. Let's fill in the ticker symbol, which is ORCL, ORCL Corporation. So this stock, ORCL, many of you might know it. It's a pretty old IT company already. They are mostly known for their database hardware and software. This is a great business to be in for ORCL because they have a significant competitive advantage there because there are so-called lock-in effects. And what is a lock-in effect? Well, this means that, for example, once a big corporation has Oracle databases, then it costs them a lot of money if they want to switch to a competitor. If they, there are so many costs involved that many of these companies, many of the Oracle's clients, just decide to stick with them. So there's a lot of recurring revenue, and this is a very good position to be in for a company. As we see here, some key statistics: decent return on equity, high profit margin. So let's take a further look into this company. For example, by going to Guru Focus, we type in again the same ticker symbol. Look at the summary, and what we see is that they have a 5 or a 4.5 star, which is one of the rating systems Guru Focus uses. So this is a good sign. We see that they have a decent financial strength, not amazing, 7 out of 10, but decent. High profitability and growth, that scores very well there. Also, an interesting thing to look at is down here, which is called the Peter Lynch chart. You can click on this little "What is a Peter Lynch chart" thingy if you want more explanation about that. But it is one way to see if a company is currently selling at an attractive price. So you prefer to see the price below the Peter Lynch earnings line, which it's not. It's above that line at this moment. So this suggests that the company is currently not very cheap, but we'll look into that a bit more later on in this video. Another place where we can look is Jitta.com. I mentioned this website before. Again, we fill in the ticker symbol, ORCL Corporation. Here it also scores an 8 out of 10, which is very good. We see here that consistent operating margins, low debt levels, dividend payments are increasing every year, and they have relatively low capital expenditures relative to their earnings per share, which is good. You want to see companies which don't have to invest a lot of money to earn a lot of money. So that's definitely the case with ORCL. Now, what else can we look at here? The Jitta score, how it evolved over time, pretty stable, so that's good. Now let's just fill in the ticker symbol in the premium value spreadsheet I got here, which you can get from my website valuespreadsheet.com/premium. So here currently showing data for Dolby, but we want ORCL, so I fill in the ticker symbol, press enter. Now it's loading all the data. I have to wait a couple seconds. There it is. So what this has done is the spreadsheet has drawn in all the financial data for ORCL, performed all kinds of calculations and analyses, and this view you have here is actually the conclusion of that analysis. So the score is based on all these fundamental factors. It scores 85 out of 100, very good score. And here are the intrinsic values calculated using 3 different valuation models. You can see the analysis here in the analysis tab. So even if you are pretty inexperienced with investing, you still can see, okay, the return on equity 24%. the judgment of that is good. I mean, 24% is a very good return on equity. And then here in the comment it says return on equity is consistently high. Company capital invested profitably. So this gives you a bit more than, in general, also here on Guru Focus, what you get is this whole, you get this whole list of data, all these factors here, but they don't tell you what it means, and so that's what I did in the spreadsheet. It actually tells you what this means and if it's good or bad, and it gives a little explanation as well. So if we take a look at these factors, many of these are also put in graphs here in the graphs tab. Also interesting to see that here the earnings per share and the free cash flow per share has been increasing every single year for the last 10 years, which is a very, very good sign, especially because free cash flow has been higher than net earnings. This means that these earnings are sustainable, which is a very good sign. Return on equity has consistently been above 15%, even above 20%. So that's a very healthy sign. It tells us that the business is really profitable. Book value has been increasing over time. So that's a sign that the company is actually creating value. It's getting worth more over time. Net profit margin has been above 23% over the last 10 years, which is a very high ratio, or a very high margin, sorry. So that's very good. Also here, shares outstanding are decreasing, so they are repurchasing shares, which means they are increasing the earnings per share that way, and they also returns of value to shareholders through dividends. Current ratio has been increasing over time and is currently at 3.2, which is very good because you prefer a current ratio of 2 or higher, and it means that a company, in this case Oracle, is can pay its short-term obligations 3 times over. So that's really, really good sign. And debt, they do have some debt, but not that much. So this is manageable, especially given the healthy free cash flows they are generating. So this is a very healthy company. Now, this is a company I would like to own. It's a great company, strong fundamentals, and it has a definite competitive advantage, the lock-in effects I discussed before. However, then we have to look at the valuation. Is the price right at this moment? Well, the valuations differ immensely. For example, the price earnings valuation model gives us a value of 71. Well, let's take a look why. If we look at this valuation model, here it uses the industry average price earnings ratio, which is currently 33. Which is very high. It's almost unrealistically high. So let's just make that 25, which is more reasonable for the technology industry. As you can see, this lowers the value of this model to $53, which seems more reasonable to me based on a slightly lower price earnings ratio. Now, if we take a look now, you see these two are sort of in line with each other. So we could say that the value should be somewhere around here. Just to check, let's also take a look at the discounted cash flow model on Guru Focus. Here you have the DCF tab. What they say, based on the data, they give Oracle a fair value of 61. Well, again, this is close to here the DCF valuation that the spreadsheet comes up with. So let's just assume that, be on the conservative side and say that the value is around, let's just say $59. What this means is that compared to the current share price of about $41, this means the Oracle is currently undervalued almost 40%, 45%. This is interesting because now you have a great company which seems on the cheap side. So definitely an interesting stock to keep in mind. I'm not saying go out and purchase it straight away. Do your own due diligence always. That was it for this week. I hope you enjoyed it, learned a couple of things from this video. If you want to be the first to know when a new video goes live, just click the subscribe button on YouTube and leave a comment if you want me to analyze a particular stock in the coming weeks. So thanks for watching, and I hope to see you next time.